Hi, my name is Sid from KOSEC Kodari Securities, and today I will be going through a type of price chart known as candlesticks. This is what a lot of investors and professional traders use as a guide to determine possible price movements based on the patterns that occur regularly in these charts. And as always, any information given is general in nature and does not take into account your personal needs or objectives. For further information, please do visit our website www.kosec.com.au. So today we will go through candlesticks and how they work. Then we will move on to how to interpret or read them, and then on to a couple pattern types to look out for, and we will also view them on a couple charts. Now, this type of price charts actually originated in Japan in the 1700s, as it was used by Japanese rice merchants to track the price of rice. So, as I mentioned, it is a method of reading a price chart just like bar or line charts. Now, candlestick charts are actually used by traders to determine possible price movements based on past patterns. Now, trading is actually often dictated by emotion, which can be read in candlestick charts as they do display the high, low, open, and closing prices for a given time period all in one candlestick. Now, as Japanese rice traders discovered centuries ago, investors' emotions surrounding the trading of an asset have a major impact on that asset's movement. Now, candlesticks help traders to gauge the emotions surrounding a stock or other asset, helping them make better predictions about where that stock might be headed. Shown on this slide is the generic or typical form for a candlestick. It contains two major components, the body, or sometimes referred to as the real body, and the wick, which is also referred to as the shadow. Now, in the image shown here, it gives a more in-depth guide as to how to interpret a candlestick. As you can see, the wick represents the extreme highs and lows for the period. If the high and low is equal to the open and close, then obviously it would not have a wick, would have just a body. For example, if this price right here was the closing price, then the body would extend there. And if the low here was the opening price, then the body would extend here. Now, the body represents the difference between the opening and closing prices. If the candle is green, then the close was higher than the open, and if the candle is red, then the close was lower than the open. If the opening and closing prices are equal for the period, then the candlestick will form a type of candlestick called a doji, which I will talk about on the next slide. So this is all the forms of a doji. Now, a doji is the name for a candlestick of a period where the open and closing price are relatively equal. Now, in Japanese, the term doji loosely translates to blunder or mistake. This is actually a comment on the rarity of the open and closing prices being exactly the same in a period. So, very rarely does this occur. Simply put, a doji candlestick signifies indecision between the buyers and the sellers. Now, something I'd like to point out is that in isolation, a doji candlestick is a neutral indicator that provides very little information. However, depending on where the open and close line fall, a doji can be described as neutral or long-legged, a dragonfly doji, or a gravestone doji. Now, where the neutral and long-legged dojis don't say much on its own, the dragonfly doji is a bullish signal, which is obviously this one here, and the gravestone doji, which is this one here, is a bearish signal. Now, that's because obviously the open and close are at the top are the well, it opened at the high and it closed at the high for a dragonfly doji, and it did go to a low point here, but then buyers pushed it all the way back and it closed up here. So that's the logic behind why it would be a bullish signal. Now, for a gravestone doji, it's the opposite. So it opened here, then it got bought up, went all the way up here, and then the sellers came in and pushed it all the way back down to around the same price that it opened. So that's the gravestone doji. Now, just to recap about dojis, dojis essentially signify indecision. The open price and the closing price are relatively equal, and there are two variations of the doji apart from the neutral doji, which is the dragonfly doji, which is a bullish reversal signal or pattern, usually occurs at the bottom of downtrends, and the gravestone doji, which is a bearish reversal pattern and usually occurs at the top of uptrends. Now, with regards to dojis, the longer the wick, the greater the price rejection. Now, moving on to types of candlestick patterns. First, we will look at a couple of single candlestick patterns, and we will start off with the hammer. As seen here, this is what a hammer candlestick looks like. The body of the candlestick would be the head, and the wick of the candlestick would be the handle of the hammer. The hammer formation is created when the open, high, and close are roughly the same price. Also, there is a long lower wick around twice the size of the real body. Now, when the high and the close are the same, a bullish hammer candlestick is formed, as it is considered the stronger hammer formation, as shown here on the left. This is because the bulls were able to reject the bears completely. Plus, the bulls or buyers were able to push the price even more past the opening price. As you can see here, the close is here, and the bulls pushed it from the low here all the way up to close right here. Now, in contrast, when the open and high are the same, this hammer formation is considered less bullish, but still is a bullish formation. The bulls were able to counteract the bears, but they weren't able to bring the price back to the price at the open. As you can see here, it went all the way down and it came back up, but they weren't able to reach this spot. So that's why it's this one on the left here is considered the stronger hammer formation. So just to recap, the hammer candlestick is a bullish reversal signal. The wick tends to be longer than the body, at least or around twice as long as the body. And I do want to reinforce that don't trade it by itself. Don't just use a hammer by itself. Look at, potentially other indicators like MACD or stochastic oscillator, just as an example. Or you can also use other patterns or other candlesticks as well. But please do use it with other things or other technical indicators as a confirmation as well. Don't just trade based on the hammer. Moving on to the next single candlestick pattern known as the shooting star. As you can see here, it looks like an upside down or inverted hammer. However, they do not signify the same thing. A shooting star is a bearish reversal candlestick which occurs in an uptrend. The shooting star formation is created when the open, low, and close are roughly the same price, and there is a long upper wick, once again, at least twice or around twice the length of the real body. When the low and close are the same, a bearish shooting candlestick is formed, and it is considered the stronger of the formation, which is this one right here. Now, as you can see, the bears were able to reject the bulls completely. Plus, the bears or the sellers were able to push the price even more by closing below the opening price, as you can see here. So it opened here, went all the way up, and then the sellers came in and pushed it all the way down below the open to close there. So just to recap about the shooting star, it is a bearish reversal signal, very similar to the hammer in that the wick is longer than the body, around twice as long. And once again, just like the hammer, do not just use this signal by itself. Do look for other signs as a confirmation. Now we will look at a candlestick pattern that consists of two candlesticks. This pattern is known as the engulfing pattern. It comes in two forms, bullish and bearish engulfing. This image here shows what a typical engulfing or a generic engulfing pattern looks like for both variations. As you can see in both instances, the body of the second candlestick completely envelops the body of the first candlestick. This is why it's called the engulfing pattern, because the second candle engulfs the first. Ultimately, traders want to know if the engulfing pattern represents a change of sentiment so that they can take action. In the case of a bullish engulfing pattern, they usually occur at the bottom of a downtrend, so a trader would anticipate an upward movement from there. It's the opposite for a bearish engulfing pattern, because in this case, it tends to occur at the top of an uptrend. Traders would then anticipate a movement back down for a bearish engulfing pattern. Now, before acting on the pattern, one would usually wait for the second candlestick to close and wait for the third candlestick as a confirmation to take action. Therefore, if a bullish engulfing pattern is spotted, then you would want to consider buying or longing on the third candlestick, considering it closes or it opens and closes above, or the price is above the second candlestick. Now, is the opposite for a bearish one. In terms of the bearish engulfing pattern, you'd want to consider selling or shorting on the third candlestick once you confirm that it's starting a movement back down. Now let's use a candlestick chart of a stock to see if we can spot any engulfing patterns. Now this stock is Credit Corp Group Limited. ASX code for it is CCP. So we're starting at around 2019 here. Let's start from the left, work our way to the other side. So we see a little bit of an engulfing pattern there. You can see that the green candlestick, the body is completely enveloping or engulfing the body of the red candlestick. Could be considered an engulfing pattern. You would want to take action once again. Take action on the third candlestick. Now, not only does the third candlestick open higher than the close of not only the close, also the high of the previous candlestick, but it's also crossed north of this 200-day exponential moving average. So you could look at the third. That could be a very strong confirmation. It's crossed the moving average, and it's also just come off of. It's the third candlestick of a engulfing pattern. So that could be one way you could use that. Once again, if you had bought there and held it, you could have ridden it all the way up here. Now, obviously, there were in the middle, in between, there would be a couple of signals to sell. Could have sold it and bought it back here, here, wherever. But once again, that would have been a very good time to enter. Now, obviously, if you didn't spot that there, if it wasn't convincing enough for you, this spot here is another bullish engulfing pattern. So not only has the green and completely engulfed the red on the left, but it's also gotten quite close to that 200-day exponential moving average. It's bounced back up, and then you could have potentially picked it up on this third candlestick right there, or on that day right there. Now let's look here. Here you can spot these two right there. Let me just, yep. So these two right here, that could potentially be a bit of a bearish engulfing. You can see that's the red candlestick. The body of the red candlestick completely engulfs the body of the green candlestick. It's at the top of an uptrend right here, and you can see after that this third candlestick, which is blocked by the marker, this third candlestick right here is the confirmation right there. It's below this one here, so that could have been where you sold off and potentially could have picked it up once again back here. So to summarize, an engulfing pattern is a pattern that uses two candlesticks where the body of the second candle completely engulfs the body of the first. There's two variations, a bullish engulfing and a bearish engulfing candlestick. And once again, I would like to reinforce that, and now you will hear me say this a lot, do not trade it do not just use it by itself. Do look at a couple of the indicators. In the example previously, we used that 200-day exponential moving average, but you could use other indicators as well, MACD, stochastic oscillator, and so on. The other two candlestick pattern we're going to look at is known as the tweezer, which comes in two forms as well, tweezer top and tweezer bottom, as shown on the slide here. Now, tweezer patterns is used as a guide to indicate a shift in trend direction. However, since tweezers can occur quite frequently, usually a broader context is taken into account as a confirmation. Now, the topping pattern occurs when the two highs of the two consecutive candlesticks are relatively equal following an uptrend, which you can see here. Now, the opposite, which is a tweezer bottom, occurs when the two lows of two consecutive candlesticks are relatively equal following a downtrend, which you can see by this line here. Now, something to take into account for this pattern is that the first candlestick has a large body. However, the second candlestick can be pretty much any size, or the body of the second candle can be pretty much any size. For example, in a tweezer bottom, the first candle may be a very strong downwards or bearish candle closing near the low, while the second candle could be anything, even a doji, which has a similar low to the first candle, which that is the key. Now, ultimately, the premise behind this top or bottom pattern is that while the first candlestick shows a strong movement in the current direction, the second candlestick either halts or reverses the previous day's price action. this is what signifies a short-term shift in momentum and is something to be aware of, really. Now, looking at an example, this is the stock ANZ, Australia and New Zealand Banking Group, or ASX code, once again, ANZ. Now, let's look at these two right here. This could potentially be considered a tweezer top. Now, if you notice the high for this left candlestick here and the high and the close for this candlestick here are relatively around the same level. And then you can, after that, you can see a huge downward trend here. Once again, this line here is that 200-day exponential moving average. So you could have potentially looked at picking it up near the end of the day or near the close on this candlestick. Could have picked it up there near that moving average. It's bouncing off the moving average and coming back up, which is showing that the buyers are pushing it back up, which is a good sign. However, the important thing to focus on is this tweezer top pattern right here, which then right after that, the momentum that it had, the trend up that it had, completely reversed and went all the way back down. So just to recap, the tweezer pattern is another two candlestick pattern. It can actually sometimes also have three, but the typical tweezer usually has two candlesticks. There's two variations, once again, the top tweezer and the bottom tweezer. And once again, do not just use it by itself. Look for other confirmation signals. As I said, sometimes tweezers are quite frequently occurring, and it can be hard to spot. So look for other confirmation signals as well, and use it in a broader context. Now, finally, we will be looking at a type of candlestick pattern which involves three candlesticks. These patterns are known as the morning star pattern and the evening star pattern. And as shown on the diagram here, they are mirror images of each other. Both these patterns are reversal patterns. However, the morning star occurs at the bottom of a downtrend, while the evening star occurs at the top of an uptrend. Now, this diagram depicts the criteria that needs to be met for it to be considered a morning or evening star. As I mentioned earlier, they are about mirror images of each other, and you can see this by noticing that in the morning star pattern, the first candle is a long and bearish candle right here, and the third candle is a long and bullish candle right there. Now, in contrast, in the evening star, you can see that it's actually the opposite. The first candle is a long and bullish candle, whereas the third candle is a bearish candle. Now, something to take into account is that in either cases, the second candle can be any type of candle. It can be bullish, bearish, or even a doji. However, it typically tends to be small and indecisive, as you can see right here and here. Now let's look at a couple of examples to see whether we can spot any morning or evening star patterns. Now, going back to the example from the tweezer, once again, ANZ Bank or Australia New Zealand Banking Group. Now, if you look here at the bottom, you can notice this three candlestick pattern, which looks very similar to a morning star pattern. As you can see, that second candle, there's a gap between that first and second candle and a gap between that second and third candle. And you can see that the middle candle there, it's very indecisive. The first candle is a long bearish and the third one is a long bullish. So this could be taken as a morning star candle. Additionally, it's also a morning star pattern. Additionally, it's also at the bottom of a downtrend. Now, moving on to the next example, we're looking at the chart of Westpac Bank here, which is ASX code WBC. Now, let me just draw your attention to these three candles right here. Now, that looks quite like an evening star pattern. Now, if you can see, the stock has been kind of on an upward trend right here, shot up there. The first candle right here, let me just get these marks out of the way. The first candlestick right here is in the direction of the trend. It's a bullish candle. Then we go up here, and then the third candlestick is in the reverse or the opposite direction. It's a long body bearish candle. So that's the criteria for that evening star pattern. Once again, I mentioned in the evening or morning star, that second candle can be any form of any type of candlestick. In this case, however, something to note is that this right here is a shooting star. Now, we actually discussed that earlier on in this presentation, and that in itself is a bearish reversal indicator or signal. Now, putting that together with these three, that's two bearish reversals right there, two indicators there that could potentially that indicates that this could turn around. So that's two indicators right there. And as you can see, after this third candlestick here, it's been on a fairly long downward trend. So just to summarize, the morning and evening star patterns are patterns that involve three candlesticks. They are reversal patterns. The morning star forms at the bottom of a downward trend. The evening star forms at the top of an upwards trend, and they are mirror images of each other. So in this presentation, we went through quite a few things about candlesticks, looked at a couple candlestick patterns, and saw some examples of the patterns on charts. Hope you have found this video helpful. This video has been brought to you by KOSEC, Kodari Securities. Thank you and have a nice day.